Earlier today, silver looked finished, dead in the water. People started whispering, "Top is in." Then something happened. Money didn't leave. It rushed back in. Silver exploded. Gold followed. Records shattered. And the man who pulls silver out of the ground said one sentence that should make you pause. "This is once in a lifetime, and we are not done yet." But here's the real question. If this move was only the beginning, what happens next? And who gets caught on the wrong side when the door suddenly closes? Stay with me, because what you're about to hear changes how you see silver forever. Welcome to Market Metal. Begins at a moment of confusion, not clarity. Earlier in the day, the market appeared to make up its mind. Gold and silver were sliding. Commentators were already preparing their explanations. The usual language surfaced: profit-taking, exhaustion, the idea that the rally had gone too far and that gravity was finally returning. To many observers, it looked like the end of a trade. But markets rarely end with calm agreement. They end with contradiction. As the session progressed, capital did not quietly exit. It reversed. Buyers returned with force, not hesitation. Prices rebounded sharply. By the close, both gold and silver were pressing into new record territory. The narrative that had seemed settled only hours earlier was suddenly obsolete. This pattern matters, not because prices went up, but because of how they behaved when they were supposed to fail. Silver, in particular, was not behaving like a tired asset. It was behaving like an asset responding to pressure. Year to date, silver had already surged close to 60%. The year before, it had posted a gain that few mainstream assets could match. These were not the moves of a market limping forward on hope. They were the moves of a market absorbing demand faster than supply could adjust. Gold's role was important, but familiar. Gold often moves first in periods of monetary stress. It acts as an early warning. Silver, historically, follows later, and when it follows, it tends to move faster and with less restraint. That relationship has repeated across cycles. What made this moment different was not that silver was rising, but that it was rising while many were publicly declaring the move finished. At that exact moment, a producer spoke. On Fox Business, the chief executive of Pan American Silver, Michael Steinman, was asked a simple question. Had he ever seen anything like this before? His answer was direct: no. He described the move as a massive outbreak in silver prices. He said the industry had been waiting for it. He added something more important. He did not believe it was over. For seasoned market observers, this was the first signal that deserved attention. Mining executives are not traders. They do not benefit from short-term excitement. Their businesses operate on timelines measured in years, sometimes decades. New mines are not turned on because prices spike. They require permitting, financing, labor, infrastructure, and political stability. When a mining CEO speaks with confidence during a volatile price move, it usually reflects conditions already visible on the ground. This is where Part 1 draws a line between noise and signal. When markets sell off early in the day and recover aggressively, it often indicates that selling pressure is being absorbed by larger buyers. These buyers do not chase headlines. They respond to structure. They step in when liquidity thins and prices dip into zones where long-term demand outweighs short-term fear. Silver's rebound followed that script closely. Another detail mattered. The rebound was not isolated to futures markets alone. Mining equities followed. Shares of Pan American Silver had risen dramatically over the past year, reflecting not just price appreciation, but improved expectations around margins, reserves, and future production. Equity markets tend to discount the future. When they move in sync with the underlying commodity, it suggests alignment rather than speculation. The broader context reinforces this interpretation. Silver's market is small compared to gold. That fact is often ignored, but it has consequences. When capital reallocates toward silver, whether for industrial reasons, monetary hedging, or portfolio diversification, the price response is magnified. There is simply less inventory available to absorb large flows smoothly. At the same time, silver is not a pure monetary metal. It is deeply embedded in modern industry. Electronics, energy infrastructure, and manufacturing rely on its unique properties. This creates a baseline level of demand that does not disappear when investor sentiment shifts. Unlike purely financial assets, silver cannot be sidelined without disrupting real-world production. This dual role creates tension. When monetary demand rises alongside industrial demand, price movements become unstable. Corrections happen, but these are often sharp and brief. They shake out weak positioning rather than end cycles. This is why the early day sell-off was more revealing than the rebound. It showed how quickly pessimism surfaced and how quickly it failed. From an analytical standpoint, Part 1 establishes a critical principle. Markets that are truly finished do not attract aggressive buying on weakness. They drift, they stall, they lose attention. Silver did none of those things. Instead, it displayed a behavior common near the early and middle phases of structural repricing: high volatility, competing narratives, and repeated attempts to declare a top before one has actually formed. The CEO's remarks fit into this framework. He spoke not about excitement, but about production, reserves, and long-term development. He discussed increases in output that take time to execute. He pointed to regions where silver is geologically concentrated, reminding listeners that supply is not evenly distributed or easily replaced. This matters because prices are ultimately governed by physical reality. Paper markets can move faster than mines can respond, but they cannot outrun them forever. Part 1 closes with a question rather than a conclusion. If silver were truly near a final peak, why would producers be planning increased output years into the future? Why would buyers return so aggressively on the first sign of weakness? And why would a seasoned executive describe the moment not as an ending, but as something still unfolding? The answers do not require prediction. They require observation. In the next part, the focus will shift away from price charts and toward the mining side itself, where signals are slower, quieter, and often more reliable. What the ground is telling the market. Part 2 begins away from screens, headlines, and price charts. It begins where silver actually comes from. Markets often assume that when prices rise, supply will quickly respond. This assumption works for manufactured goods. It does not work for metals pulled from the ground. Silver is not produced on demand. It is discovered, permitted, financed, and extracted through a process that moves far slower than capital markets. This is the first disconnect most observers miss. When silver prices surge, the public expects mines to flood the market with new supply. But mining executives know a different reality. High prices today do not create new ounces tomorrow. In many cases, they do not create new ounces for years. This is why producer commentary matters more than commentary from analysts. At the center of this signal sits Pan American Silver, one of the largest primary silver producers in the world. When its leadership speaks about expanding production, the statement does not describe an immediate reaction. It describes a long, capital-intensive plan that depends on geology, labor, political stability, and time. The company's chief executive, Michael Steinman, outlined expectations of increased silver output in the coming years. To a casual listener, this sounded like optimism. To an experienced observer, it sounded like restraint. Why restraint? Because even planned increases were modest relative to the scale of price movement. Silver prices had surged dramatically, yet production guidance increased only incrementally. This gap is not an accident. It reflects the physical limits of the industry. Silver mining is often underground. It follows narrow veins rather than wide open pits. Grades vary. Costs are sensitive to energy, labor, and regulatory pressure. A mine cannot simply double output because prices are higher. In many cases, pushing production too aggressively damages long-term economics. This creates a structural delay between price signals and supply response. Part 2 focuses on this delay because it is where suspense builds. If prices rise faster than supply can adjust, pressure accumulates, not on paper, but in inventories, contracts, and delivery schedules. This pressure does not release smoothly. It releases through volatility. Another layer deepens the tension. Much of the world's silver is produced as a byproduct of other metals such as copper, lead, and zinc. This means silver supply is often dependent on demand for entirely different commodities. Even if silver prices rise sharply, production cannot increase unless those primary metals are also being mined at higher volumes. This structural dependency limits elasticity. The result is a market where demand can surge rapidly, while supply remains anchored to decisions made years earlier. When investor interest overlaps with industrial demand under these conditions, price behavior becomes unstable by design. This is not theory, it is history. Silver has repeatedly shown this pattern across cycles. It lags gold. Then, when it moves, it compresses years of repricing into months. Corrections appear violent, but they rarely resolve the underlying imbalance. The mining side understands this better than anyone. Executives do not celebrate volatility. It complicates planning, it attracts political attention, it raises costs. When a mining CEO describes current conditions as unusual and potentially unfinished, it often reflects sustained demand rather than short-term excitement. Another point increases the tension: geographic concentration. Silver reserves are not evenly distributed. A significant portion of global production comes from a small number of countries, particularly in Latin America. This concentration introduces jurisdictional risk. Policy changes, taxation, labor disputes, or environmental restrictions can interrupt supply unexpectedly. Markets tend to ignore these risks during stable periods. They price them suddenly during stress. This means that even if demand remains constant, perceived supply reliability can change overnight. When that happens, price adjustments are rarely gradual. Part 2 emphasizes this because it reframes the rally. It is not simply a reaction to inflation, speculation, or fear. It is a collision between slow-moving supply and fast-moving capital. Another misunderstanding often surfaces at this stage. Commentators argue that high prices will eventually cure high prices. While this is true in theory, the timing matters. In silver, the cure often arrives late. Years of underinvestment during low-price periods reduce the industry's ability to respond when prices rise. Projects that were shelved cannot be restarted instantly. Skilled labor cannot be trained overnight. Permits cannot be accelerated without consequence. This creates a lag that markets underestimate. From a strategic perspective, this lag is where risk accumulates. Not just upside risk, but systemic risk. When physical constraints collide with financial demand, markets search for balance. They rarely find it calmly. Part 2 does not suggest certainty. It highlights asymmetry. The downside risk is visible and frequently discussed. Pullbacks, corrections, sentiment shifts. The upside risk is quieter and harder to model. Supply bottlenecks, inventory stress, and delayed responses that only become obvious after prices have already moved. This imbalance is why producer guidance matters more than daily price action. As Part 2 closes, the suspense is not about whether silver prices will fluctuate. That is inevitable. The suspense lies in whether the market fully understands the structural limits beneath those fluctuations. If supply cannot respond quickly and demand does not retreat meaningfully, pressure does not disappear. It transfers. In Part 3, the focus will shift to where that pressure often goes next, into the intersection of industrial necessity and monetary behavior, where silver's dual identity creates outcomes few participants are prepared. When industry and money collide us, Part 3 begins with a contradiction most markets struggle to price correctly. Silver is treated like gold during fear, but consumed like copper during growth. It is both a store of value and a working material. That dual identity is not a feature. It is a problem, and problems create suspense. Unlike gold, silver is not locked away and admired. It is used, shaped, consumed, and often lost. Once silver enters industrial systems, electronics, energy infrastructure, medical equipment, it does not return easily. Much of it is uneconomic to recycle at scale. This creates a quiet drain on available supply that builds over time. Markets rarely focus on this drain. They focus on price. At the same time, silver carries a monetary shadow. When confidence in currencies weakens, investors look for assets with history, scarcity, and independence from policy. Gold usually moves first. Silver follows later, but when it follows, it does not behave politely. This is where tension accelerates. The silver market is small, very small. Compared to global equity markets, bond markets, or even gold, silver's total annual supply is limited. When investment capital shifts even modestly towards silver, the market absorbs it poorly. Prices do not adjust smoothly, they jump. This is not speculation, it is mathematics. Part 3 focuses on what happens when these two forces, industrial necessity and monetary demand, arrive at the same time. Historically, they rarely align. When they do, silver becomes unstable. Industrial demand does not respond to price signals in the short term. Manufacturers do not stop producing electronics because silver is more expensive. Energy projects do not pause because input costs rise. Silver's unique properties, especially conductivity, are difficult to substitute without performance loss. This means demand is relatively inelastic. Monetary demand behaves differently. It accelerates during uncertainty. Inflation, currency stress, geopolitical instability, and policy inconsistency all increase the appeal of tangible assets. When investors move into silver during these periods, they are not replacing industrial buyers. They are competing with them. This competition is rarely discussed, but it is critical. When silver prices spike, commentators often blame investor enthusiasm. They overlook the fact that industrial users must still secure supply. They cannot wait for price corrections that may or may not come. They hedge, they pre-purchase, they lock in contracts. This behavior tightens availability further. Part 3 introduces another layer of suspense, timing. Silver's price history shows long periods of underperformance, followed by compressed repricing phases. These phases feel chaotic because years of adjustment occur in months. Volatility increases, narratives multiply, calls for tops and bottoms appear daily. During these phases, pullbacks are misinterpreted. Corrections do not signal resolution, they signal stress. They are attempts by the market to find sellers willing to relieve pressure. When those sellers do not appear in sufficient quantity, prices resume upward movement, often faster than before. This is why declarations of peak silver tend to cluster during strong uptrends. The discomfort increases before clarity arrives. Another structural factor intensifies the problem: inventory visibility. Much of silver's above-ground stock is opaque. Unlike gold, which is hoarded and measured, silver inventories are scattered across industrial supply chains, private holdings, and government reserves with limited transparency. When demand rises, the market does not have a clear picture of what is actually available. Uncertainty feeds volatility. This opacity matters when investor interest grows. Large buyers do not want to discover scarcity after committing capital. They move earlier. Their actions appear sudden, but they are usually preemptive. The market then reacts. Part 3 also addresses a common misconception, that silver's industrial role limits its monetary upside. In reality, it amplifies it. Industrial demand creates a floor, Monetary demand creates momentum. Together, they compress the market from both sides. This compression does not release gently. When price rises too quickly, policymakers, media, and analysts search for explanations that restore comfort. They point to profit-taking. They point to technical levels. They point to sentiment. These explanations describe behavior. They do not explain cause. The cause sits beneath the surface, a market where supply moves slowly, demand moves unevenly, and visibility is poor. In this environment, price becomes the messenger. Another source of suspense emerges when comparing silver to gold. Gold's market is deep and liquid. It absorbs capital with less disruption. Silver cannot. This is why silver often lags early in cycles and then outperforms dramatically later. The moment silver begins to outperform gold is not random. It signals a shift from hedging to participation, from defense to allocation. This shift is uncomfortable because it challenges assumptions. Investors expect silver to behave like a secondary asset. When it begins to lead, it forces reassessment. Part 3 does not argue that prices move in straight lines. It argues that behavior during pullbacks matters more than the pullbacks themselves. Who buys, who sells, and who is forced to act. When silver rebounds aggressively after declines, it suggests that demand is not exhausted. It suggests that corrections are being used, not feared. This behavior aligns with what producers have quietly indicated, that the underlying demand environment has changed. As Part 3 closes, the suspense tightens around a simple question. If silver is being pulled simultaneously by industry and money, and if supply cannot respond quickly, where does adjustment occur? History suggests it occurs through volatility first, and clarity later. In Part 4, the focus will turn to what this means for decision makers who misread volatility as resolution, and why the most dangerous moment in commodity cycles is often when confidence returns too quickly. The most dangerous phase is misinterpretation. Part 4 begins where many decision makers become most vulnerable, not during panic and not during euphoria, but during moments of partial calm, when volatility briefly slows and confidence quietly returns. This phase is deceptive. In commodity cycles, the greatest mistakes are rarely made at the peak of excitement. They are made after the first correction, when participants believe the risk has passed and the market has revealed its limits. Silver has a long history of punishing this assumption. The reason is simple. Volatility is not resolution. When prices move violently and then pull back, observers rush to label the move complete. They treat the correction as proof that the market has worked through excess demand. But in structurally tight markets, corrections often serve a different purpose. They reset positioning, not fundamentals. This is where Part 4 places its warning. Silver's recent behavior, sharp advances, sudden pullbacks, rapid recoveries, fits a pattern seen in previous repricing phases. These patterns are uncomfortable because they lack symmetry. Down moves are fast. Recoveries are faster. This creates emotional fatigue, not clarity. Decision makers often respond by reducing exposure, delaying action, or waiting for stability that never fully arrives. Another source of misinterpretation comes from media narratives. Headlines declaring peak prices tend to appear after sharp gains, especially when intraday reversals occur. These narratives focus on visible price action, not underlying constraints. They offer reassurance at precisely the wrong time. The mining industry's signals contradict this reassurance. Producers do not plan multi-year expansions if they believe prices are peaking. They plan cautiously when they expect sustained demand. Even then, they are constrained by physical, regulatory, and financial limits that cannot be bypassed by optimism alone. This creates a timing mismatch. Markets adjust faster than supply. When that happens, price becomes the balancing mechanism. Part 4 emphasizes a critical strategic error, confusing price volatility with demand volatility. Demand for silver is not purely financial. It is embedded in systems that do not turn off easily. Energy infrastructure, electronics manufacturing, and industrial production rely on silver's properties. These systems absorb price increases rather than eliminate usage. At the same time, monetary demand does not require industrial justification. It responds to confidence, currency stability, and policy credibility. When those factors weaken, silver attracts attention, not because it is convenient, but because it is independent. This dual demand structure means that silver does not need enthusiasm to remain bid. It needs only persistence. Another danger emerges when investors compare silver's behavior to gold's. Gold's rallies are often smoother. Its pullbacks feel controlled. Silver's do not. This leads to the false conclusion that silver is inherently unstable or unreliable. In reality, silver's instability reflects its smaller size and tighter supply. When capital moves in or out, the effect is magnified. This does not make silver weaker, it makes it more sensitive. Sensitivity is often mistaken for fragility. Part 4 also addresses policy and geopolitical risk, not as speculation, but as background pressure. Silver production is concentrated in specific regions. Changes in taxation, regulation, or labor conditions can disrupt supply unexpectedly. Markets tend to price these risks suddenly, not gradually. When such risks coincide with elevated demand, price reactions become nonlinear. This is why calm periods within volatile trends are dangerous. They invite complacency. They suggest that the system has absorbed stress when it may only be redistributing it. From a strategic standpoint, the question is not whether silver will experience pullbacks. It will. The question is whether those pullbacks represent relief or reloading. History suggests they often represent the latter. Part 4 introduces a final layer of suspense, participation. As silver's move becomes more visible, participation broadens. This does not happen all at once. It occurs in stages. Early participants focus on fundamentals. Later participants respond to performance. The transition between these groups is rarely smooth. During this transition, price behavior becomes erratic, signals conflict. Confidence rises and falls quickly. This environment rewards patience and punishes assumptions. The most costly assumption is that the market will offer clear confirmation before moving again. It rarely does. Instead, markets tend to move when certainty is lowest and narratives are most divided. By the time consensus forms, adjustment is often well underway. This is why the words of industry insiders carry weight during these phases. They do not describe price targets, they describe conditions. When a seasoned executive describes current dynamics as unusual and ongoing, it suggests that the system beneath the price is still shifting. Part 4 does not predict outcomes. It outlines risk. The risk is not limited to price declines. It includes opportunity cost, misallocation, and delayed recognition of structural change. In fast-moving cycles, waiting for comfort can be more expensive than acting amid uncertainty. As this 4-part analysis closes, the warning becomes clear. Silver's recent behavior is not a headline event. It is a signal embedded in volatility. It reflects tension between slow supply and fast capital, between industrial necessity and monetary caution. Those who treat volatility as noise may miss the message entirely. Those who understand it as pressure may recognize that the most important phase of a cycle is often the one that feels the least settled. The market is not asking for belief, it is asking for attention.